okay, between 10 to 11. So that is an hour before we start the class. So I will be in my office on Wednesday and Friday, okay? So if you would like to get some specific feedback or you would like to ask any question from the course, just feel free to drop by, okay? I will be in my office around 10 on Wednesday and Friday. Now Friday is our scheduled consultation, but also you can come in to see me on Wednesday if you have any question, okay? All right, now, so that is about technical assignment, and let's move on to have a look at the topic we are going to do today. All right. Now, in our previous session, the group under discussion only include one subsidiary, right? Now, today also one subsidiary. So we're going to have a look at multiple subsidiaries group structure on Friday, okay? There's a group under discussion is also only involve one subsidiary, but this time the parent ownership interest in the subsidiary will be less than 100%. Okay? Now, this will involve the measurement of NCI. And also we need to record NCI-related entries in your consolidation worksheet. Okay. Now, we continue our discussion of ASB 10, the consolidated financial statements, but we're going to introduce NCI in today's topic. Now, what is an NCI? What is meant by the term non-controlling interest? So you can see NCI is the term used for the ownership interest in a subsidiary other than the parent. This is defined in ASB 10. The equity in a subsidiary not attributable directly or indirectly to a parent. Now the key word here is equity. Now you can see from the definition, NCI is classified as an equity rather than a liability. Now why not liability, right? So you probably wonder why not liability. Now let's go back to recall the definition of liability. It requires present obligation resulting from past events and will eventually have future economic benefits flow out of the entity. Is there any existing present obligation? Or you can ask, does subsidiary have present obligation to pay anything to the NCI party? Now, the answer is no, right? So you can see NCI cannot fit into the definition of a liability because the subsidiary has no present obligation to pay anything to NCI party. So it better fits the definition of equity. Right? And therefore, NCI should be presented under the equity section in the consolidated statement of financial position, separate from the parent shareholder's share of the consolidated equity. Now, how to identify the NCI share of the consolidated equity? Now, just be careful. It's not a simply share of book equity of the subsidiary. That is not right, okay? Because the subsidiary's equity will be adjusted due to the fair value adjustment or due to the existence of intragroup transactions. Okay? So therefore, NCI not simply gets a share of subsidiaries recorded equity, but gets a share of consolidated equity that is contributed by subsidiary, which in other words, NCI receive a share of the group equity, right? And that part of the equity is contributed by the subsidiary entity. Or we can say NCI receive a share of the subsidiary equity that is reflected in your consolidated equity. Okay? Now, and the NCI share of profit after tax is also required to be disclosed in the statement, consolidated statement of P&L, and is a share of the total comprehensive income in the consolidated statement of comprehensive income. Okay. Now, then you can see the movement in the NCI must be disclosed in the statement of changes in equity. Now, you can see accounting standard require a separate disclosure of NCI from the parent's shareholders' share of the consolidated equity. If you open the equity balance, if you open the annual report, I will just show you the annual report here, the Woolworths annual report. So if you look at the annual report, the consolidated statements of P&L, right? Consolidated statement of P&L. Now this line information, profit for the period, that is a group, the group profit for the year. So the group profit for the year is required to be divided into two parts. Now this is according to ASB 101 presentation requirements, okay? So we have to separately disclose the parent shareholders' share of the consolidated P&L from NCI share. Now, why is that? Why we must have a separate disclosure? Why such a requirement? So any idea? Now, this is consistent with ASB and IFRS reporting requirements, right? Now, if you are the shareholders of the parent company, you will be interested to know the amount of the profit, right? From the group perspective, the amount of profit that is accrued to you. You are the shareholders of the parent entity, okay? Separate from the NCI. So both NCI and shareholders of the parents, they are the contributor to the group equity. So the NCI share of the consolidated equity balance required to be disclosed separate from the parent shareholders here. Now this is in the statement of P&L. Now then, if you're moving down to look at the statement of other comprehensive income, you first of all have to calculate the total comprehensive income for the period. And that is equal to the profit for the period from the statement of P&L, right? From the previous statements, and plus the net of tax other comprehensive income for the period. Then you got total comprehensive income. Now, once again, the total comprehensive income need to be divided into two parts: the parent shareholders share, NCI share. Now, then finally, in the statement of changes, in the statement of financial position. Okay. Now, under the equity section, so you have total equity for the group, which is equal to the net asset, right? The total equity equal to net asset. The total equity of the group then divided into two parts: the equity attributed to equity holder of the parents and the NCI share. Okay. So you can see NCI is classified as an equity and should be disclosed under the equity section in the consolidated statement of financial position. Now is finally statement of changes in equity. So you can see this is all for the parents, right? Oh, sorry about that. Now this is for NCI. So the movement in the NCI during the year need to be disclosed. And in the statement of changes in equities, you can find the changes in NCI balance from the beginning to the end, and what caused the changes, right? In these statements here. So now we understand the disclosure of the NCI, so which is required by accounting standard in the statement of financial performance, statement of financial position, and the statement of changes in equity. All right, now let's look at the following MCQ question. The last one, right? Non-controlling interest, well done. Okay. Let's look at the next one. The part of the equity, right? The second one. So you can see the NCI being a part of the equity in the subsidiary, right? Contribute to the equity of the consolidated group, and so is entitled to a share of the consolidated equity. Nevertheless, the measurement of the NCI share of equity involved by firstly allocating to the NCI a part of the subsidiary's equity proportionally to the ownership interest that it holds in the subsidiary. However, because the subsidiary's equity is affected by profit loss made in relation to transaction within the group, the calculation of NCI is affected by the existence of intragroup transaction. But not all the intragroup transaction will affect NCI calculation. So we're going to show you the example later. Okay. Now let's have a look at the next one, disclosure of the NCI. All of these statements, right, as I showed you earlier in the example, the consolidated statement of change in equity shows the movement in the NCI over the period of time. The consolidated statement of financial position on the equity section, we have to disclose the NCI share of the group equity balance. And in the consolidated statement of comprehensive income, so we must have a separate disclosure of NCI share of group current P&L and the NCI share of the group total comprehensive income. Okay. So that's what we choose D, the last one. Right, now, so what is the NCI? Now, if you look at the group structure we have here in the example, assuming parent acquired 75% interest in a subsidiary. So there is a parent-subsidiary relationship because you're holding the majority of the voting rights. Now, the remaining shares in the subsidiary is known as a NCI interest. Now, to be more specific, we call this direct non-controlling interest. That is a DNCI, direct non-controlling interest. Now, why is it DNCI? Because this part directly holding shares in the subsidiary, right, for 25% in this example. Now, how to calculate the NCI share of equity? Now, as we have previously explained, NCI is entitled to a share of the equity of the subsidiary, but subsidiary's equity might be affected by, might be impacted, right, by the profit loss made on intra-group transaction. So you may need to adjust the equity of the subsidiary, right, due to the effect of the intra-group transaction, where subsidiary, including its record, there are unrealized profit loss made up from these intra-group transactions. So just be very careful. The direction of the transaction matters here. It must be the subsidiary, including in the subsidiary record, there are some unrealized profit loss made on the intra-group transaction. If the profit loss is in the record of the parent, those intra-group transactions have no impact on NCI, okay? Because NCI here receive a share of the subsidiary's equity that is reflected in the consolidated accounts. So we normally will calculate the NCI by using two stages. Stage one, we allocate subsidiary's equity to its NCI. And then in stage two, identify all the intra-group transactions where subsidiary record the unrealized profit loss. And after you eliminate entries, you need to adjust NCI accordingly. For the intra-group transaction, where parent entity recognize profit loss, you don't worry about that. You just need to prepare elimination entries as we did in the previous topic. Okay, so there's no NCI if the unrealized profit loss is in the record of the parent's book. Now later we're going to show you an example to demonstrate how we are going to prepare these entries in relation to the NCI by using these two stages here. Now there are two types of NCI. Today we just focus on DNCI. We only have DNCI when the group under discussion here only includes one subsidiary. Okay? But when there are multiple subsidiaries, we are going to have a look at whether there is an existence of INCI. So the INCI will be discussed this Friday, okay, not next week, sorry about that. So this Friday, so we're going to have a look at the INCI and its calculation. Now I believe topic 6 might be the most challenging one, and after that, the rest of topic is relatively simple compared to the consolidation topic. All right, now let's have a look at the, it's frozen. Okay, let's look at the next MCQ question. The last one, right? Very good, well done. So NCI interest entitled to a part of the equity of the subsidiary entity as reflected in your consolidated equity, right? Very good. Which in other words, the NCI receives a share of the the group equity, right? The group equity that is contributed by the subsidiary entity. Now let's move on to have a look at the format of the worksheet. Now you might notice it's different from the worksheet we used earlier, right? Now why is it necessary to change the format of the worksheet where NCI exists in the group? Now, as AASB accounting standard as well as International Financial Reporting Standard requires the disclosure of the equity of the group as well as the relative proportions of the equity that belongs to the parents, shareholders, and the NCI. Now, the reason, as we have mentioned earlier, is the accounting standard asks for separate disclosure of the parent and NCI share of equity is that the owners of the parent want to determine the profitability and the equity of the group that will accrue to them, separate from that belonging to NCI. Now, as such, disclosure of NCI is required in consolidated statement of P&L, other comprehensive income, consolidated statement of financial position, and the consolidated statement of changes in equity. Okay. Now, for wholly owned subsidiary situation, now the final column in the worksheet represents the group position. This is our final column before, right? When there's wholly owned subsidiary, okay? So this represents the group position, also the parent's position, as there is no NCI. Now, where an NCI exists, having determined the group position, the equity must be divided into two parts, right? The NCI share, the parent's shareholders share. So we will going to get NCI share first and subtract the balance from the group balance, you will get parent shareholders share. Okay. Now let's take share capital as an example here. Now this is the acquisition day share capital balance of parents and subsidiary, which in other words, this 100,000 represents subsidiaries pre-acquisition share capital balance. Okay. Now when you combine parent subsidiary share capital balance, you get total 600,000. But you need to prepare pre-acquisition entry. So pre-acquisition entry is required because we need to eliminate the parent's portion of subsidiaries pre-acquisition equity balance. This is to avoid double count the group equity. Now, how we are going to do that? Now, parents' share interest in the subsidiary is 75%. Therefore, 75% of 100,000 with debit share capital. Okay, with debit share capital. Here also have a debit retained earnings and credit investment in subsidiary, for example, here. Okay, right? Yeah. So these are pre-acquisition elimination entries. Now, then 600,000 minus 75,000, so you can see the group share capital balance is 525,000. Right. And then we allocate 25% of subsidiaries pre-acquisition equity proportionally to NCI. So there will be a debit share capital, debit retained earnings, and then credit NCI. So you can see the first entry you prepared in the adjustment here, this is your pre-acquisition entry. And the pre-acquisition entry is to eliminate, right, the parent's portion of subsidiary pre-acquisition equity. But when you record the NCI entry, now this is allocation. You allocate subsidiaries pre-acquisition equity balance proportionally to NCI. So NCI as an equity account should have a credit balance, right? So we credit NCI. Why NCI increase here? Because we allocate subsidiary pre-acquisition equity balance 25% to NCI party. Okay. Now when you subtract these numbers from the group equity balance, you will get parents' shareholders share. So this is consistent with what we have learned in the previous topic. On the acquisition date, the group equity balance is equal to the equity balance presented in the parent's balance sheet, because subsidiaries pre-acquisition equity balance are being eliminated in the worksheet, right? Are being eliminated in the worksheet. And when there is the existence of NCI, you can see parent's portion is eliminated here as part of pre-acquisition entry, but we allocate NCI share and record your NCI entry, and again, this equity balance subsidiary pre-equity balance subtract from the group, then you will get parents' shareholders share. So you can see extra 3 columns were added here in order to measure and disclose NCI related information. All right, now let's look at the next MCQ question. So this one is C, right? So everybody agree with that? Okay. So presented separate within equity section. Now considering NCI is classified as an equity, not a liability, right? So therefore should be presented under the equity section in the consolidated statement of financial position. So C is the right answer here. Well done. Now let's look at the effect of NCI on your consolidation process. So consolidation process, what is the first step? Preparing acquisition analysis, right? So we would like to know how the existence of NCI is going to affect your acquisition analysis. Is there any impact on RC entries and pre-acquisition elimination entries? Now, according to ASB 3, so you can see goodwill should be determined on acquisition day by comparing A and B, right? Now, it's not always a goodwill, just be careful. It is possible we may result in a recognition of gains on bargain purchase, but it is an unusual event, okay? Now, how to determine part A? So we're going to combining the consideration transfer with the amount of any NCI. Well, how to determine the amount of NCI? Is that the fair value of NCI or its proportionate share of subsidiaries Avina on the acquisition date? Well, it all depends on whether you are going to use full good method or partial good methods. Now, what is the difference between these two methods? Well, under the full good methods, fair value of shares of NCI at acquisition date should be identified and used in the calculation. Now, if it is a listed company, if the subsidiary is a listed company, then we can easily determine the fair value of NCI by reference to the market share price, right? The market share price for the shares not acquired by the parent entity. Now, on the partial good methods, NCI is equal to its proportionate share of subsidiaries at Avina. So the share of the equity is not really accurate. So we probably use Avina. Okay, so NCI proportionate share of subsidiaries Avina. Okay, Avina is better. Now then, don't worry about the third component. So if these will consider, right, if the acquisition is achieved in stages, but not applied in our example. Now then we compare Avina. So Avina is equal to the book value of subsidiaries identifiable net asset. Usually you just reference to the equity balance of the subsidiary on the acquisition day. Okay. And then we're going to consider if there's any asset liability require fair value adjustment. And the adjustment should always be net of the tax. Okay. Now, what is the difference between full good methods and partial good methods? So you can see under full good method, NCI is measured at fair value. And the fair value can be determined by reference to the market price of the shares not acquired by the parents. So the quoted market price can be used to determine the fair value of the NCI. Okay. Now then, on the full good methods, NCI receive a share of the goodwill. So you can see this full goodwill is referring to the total goodwill resulting from the acquisition. And this total goodwill is comprised of two components, the parent's share and NCI share. Now let's use the following example to demonstrate the calculation. So assuming A Limited acquired 60% shares of B and paid $150,000. So this is the cost of the acquisition, right? $150,000. NCI in B had a fair value of $95,000. So these $95,000 represent 40% of B's share, right? It's a market value, $95,000. The equity of B was $220,000. So this relates to the net asset, or we say the book value of the net asset, $220,000. And that is equal to total equity, which comprising a share capital, $100,000, and retained earnings, $120,000, in total $220,000. Now, by applying the equation we explained earlier. Consideration, 150,000 plus NCI fair value, 95,000. We got 245,000, right? And minus Avina, 220,000. Now the difference is the total goodwill, which has two components, right? You have to allocate this total goodwill to the parent and the NCI. Because on the full goodwill method, NCI is entitled to receive a share of subsidiaries' goodwill. Okay. Now then let's look at the calculation. Now how to determine the parent shareholders' share of the goodwill? Now we can use this equation. Consideration minus Avina acquired. Now this is actually consistent to the equation we used early on the wholly owned subsidiary. We're still using cost minus Avina acquired, right? But now the percentage of Avina acquired is no longer 100%. So you have to multiply. Could be 90%, 80%, depends on the question. Now in our case here, the goodwill acquired by the parents is equal to the consideration paid by parents, 150,000 minus Avina acquired, which is 60% of 220,000. Now the difference representing the goodwill acquired by parent. Okay. Now then, once we find out the goodwill allocated to the parents, so using total goodwill 25,000 minus 18,000, the remaining 7,000 is the amount of goodwill we allocate to NCI. Okay. Now this is one way of doing the calculation. I'm going to show you the alternative way. Now in the alternative methods, the total goodwill is made of also two components. Okay. So this is the total goodwill. So also made of two components. So that is control premium made by the parents plus the subsidiaries goodwill. Okay. Now how do you allocate these? The control premium 100% belong to parents, of course. So the parents are offering to pay the premium in order to gain the control of the subsidiary. So the control premium paid by parents all belong to parents. Okay. Now it is a subsidiary's goodwill. It is subsidiary's goodwill. In our case, it's 60%, right? 60% of subsidiary goodwill we allocate to the parents, 40% we allocate to NCI. So in order to find out the goodwill we allocate to NCI, for example, if the question here asks for the goodwill allocated to NCI, so how do that? We can find the subsidiary goodwill, right? And then we multiply 40%, you will get goodwill allocated to NCI. Now, how to determine subsidiaries' goodwill? What is the fair value of the subsidiaries share? 95,000 divided by 0.4, right? Think about that. The fair value of NCI is equal to 95,000. That represents 40% of subsidiaries share. Because parents acquire 60%, remaining 40% subsidiary share, that is NCI, right? And has a fair value of 95. Now this 95,000 represents the market value of the 40% shares. Now by using 95,000 divided by 40%, then you will get the market value for 100% shares. So let's get this calculation done. 95 divided by 0.4, right? Now this is the market value, right, for 100% shares. Now we know the market value for the entire company. We know Avina. Well, Avina is 220,000. The difference represents subsidiaries' goodwill. Okay. Now what is goodwill? It is an unidentifiable item. Like for example, talented, highly skilled staff, right? A company may have a high customer satisfaction rating, or this company has a very good relationship with the government. Now they all represent by the goodwill, and they are unidentifiable. But the market recognizes those value, right? This is reflected in the share price of the company. So by using the fair value of subsidiary share, which is 2375.5, minus Avina, right? The minus 320,000. Then you will get 17,500. Now this is the subsidiary's goodwill. Okay, this is subsidiary's goodwill. Now once we know subsidiary's goodwill, what the answer of NCI share of goodwill is readily determinable, right? We can just simply use 17,500 multiplied by 40%. Your NCI share of goodwill is equal to 17,500 multiplied 40%, which is equal to 7,000. That's done. Okay. So, well, it's really up to you which method you prefer to apply when determining the NCI share of the goodwill. So I believe this method is actually easy to apply compared to this one. It's more calculation, right? So we try to find the way to simplify our calculation. Now, alternatively, we can get control premium first, right? To get control premium. So how to get control premium? You pay 150,000 to buy 60% of subsidiary share, right? Now we know subsidiary share value for 100% is this amount. Now we multiply 60%, right? That's represented by its market value. And you pay more than the market value. That is what we call the control premium, okay? So when you pay more than the market value of the shares, the premium you paid is known as a control premium. And the control premium is all belong to the parent, okay? So if you are interested, you can have a look at these calculations, but you will get the same result anyway. Now, if the question here only asks for the total goodwill, your answer is 25,000. If the question here asks for the goodwill acquired by the parent company, it should be 18,000, right? If they ask for the goodwill that should be allocated to NCI, then the answer is 7,000. You can see for this one question, there might be a different requirements. So when you read through the question in your assessment, be very careful with the requirements. So what is the requirement in the question? Now, any question, feel free to ask, let me know, okay? Now, let's look at how the existence of NCI is going to affect your worksheet entries. Now, there are no RSC entry, first of all, right? We don't have any RSC entries, and we need to prepare pre-acquisition entries to eliminate the parent's investment in subsidiary, and then we against parent's share of the subsidiary's pre-acquisition equity. Now the parent's portion is 60%, so you have to multiply 60%, right? And in addition to that, recognize the goodwill acquired by the parent entity, 18,000. So you can see there's no impact on pre-acquisition entries, right? The rules, principles applied exactly the same as we have previously demonstrated on the wholly owned subsidiary. Now the difference here is now it's no longer 100%, right? You have to multiply a percentage based on the parent's shareholding in the subsidiary. But all the rules, principles, rationale behind this adjustment exactly the same as we have learned previously. Now then moving from here, we're going to prepare NCI entry. Now this is elimination entry. So we eliminate the parent's investment in subsidiary against the parent's share of subsidiary's pre-acquisition equity balance. For NCI entry, it's about allocation. Now we allocate subsidiary's pre-acquisition equity balance proportionally, which here based on 40% to NCI. Because we applying full goodwill method here, we need to allocate goodwill to the NCI. So NCI receive a share of the subsidiary's goodwill, right? Based on the calculation, 7,000. So there should be a debit goodwill of 7,000 included in your NCI entry. This is to allocate the goodwill to NCI party. Now, total these debit, you will get credit 95,000. Now, credit NCI here is always the balancing figure, but this number can be verified. 95,000, that looks familiar, right? Where we get that? This represents the fair value of the NCI on the acquisition day. Okay? So you can see on the acquisition day, NCI is equal to its fair value. Under full goodwill method is equal to fair value of the shares, right? Not acquired by the parent entity. Now, any question, feel free to ask or have a look at the following MCQ. The second one, so everyone else agree? Yes. Okay, all good. So B is a right answer, right? The fair value of shares that the NCI owns in the subsidiary. So B is the right one. Now, someone may say, what about C? The proportion share of fair value of the acquired is identifiable asset liabilities. This is correct if partial goodwill method is used, right? But here we ask for full goodwill method. It's under full goodwill methods that NCI is measured based on its fair value, right? And that fair value includes NCI share of goodwill. If you look at C, this is the NCI share of Avina. What is Avina? Identifiable, fair value of the identifiable net asset, okay? Now, C is correct if we are applying partial goodwill methods. Now, let's look at the calculations, and then we're going to move on to look at partial goodwill methods. Now, the question here asks for the total goodwill recorded in relation to the business combination. Total goodwill. And this is under full goodwill method. Jiangnan. Okay. Oh, is that your first week? No. Oh, but why? I probably forget to record your attendance last week. Are you here last week? Yeah. And week 2? Oh, sorry. Oh, the second class. Okay, no worries. I'll just back it up. So which one you think that is correct? No, still working on that? Yeah, don't worry, keep working on it. So anyone got the answer? A, the 62,000, any different opinion? Gao Feng? Yes. Do you agree, A? Not agree or not sure? Not sure, okay. Now, A is correct, right? A is correct. Now, let's look at this calculation together. Now, how to identify the total goodwill in relation to this business combination? So we need to identify consideration plus fair value of NCI, right? So consideration is given, 330,000. Fair value of NCI, we also can find this information here, right? That is 80,000. So in total, that is 410,000. And then you're going to determine Athena. The difference of these two represent the goodwill. Now, if you look at the equity balance of the subsidiary, that includes the share capital, 240,000, right? Plus reserve, 80,000. And then you need a fair value adjustment because one of the items is carry amount recorded 40,000 below fair value, right? For these equipments, we need to prepare fair value adjustment based on 40,000 multiplied by 70%. So adjustment should be after tax adjustment. Now, once we get Athena, let's compare these two. Now you can see consideration plus fair value of NCI is greater than Athena, the difference representing the total goodwill in relation to this business combination. Yeah. Now what is the goodwill we should allocate to NCI? So what is the amount of goodwill? we should allocate to NCI? So you can calculate the parent's share first, right? The parent shareholder share is consideration 330,000 minus Avina acquired. So Avina acquired is 348,000 multiplied by 80%. Then you can find the parent shareholders share of the goodwill. Then subtract that from your total goodwill, then you can find NCI share of the goodwill. Okay. So it all depends on the requirements, right? It all depends on these requirements. So here we only ask for the total goodwill, then the answer would be 62,000. If the question here asks for the goodwill acquired by the parents, then it is 330,000 minus 80% of 348,000. If the question here asks for the NCI goodwill, then total goodwill minus the goodwill purchased by the parents, then you can get NCI share of the goodwill. Now, any question from this practice, let me know. All right, now let's move on to look at partial goodwill methods. Now, under partial goodwill methods, NCI does not receive a share of the goodwill. So you can see the initial amount of NCI, which in other words, the acquisition date NCI balance is equal to its proportionate share of subsidiaries Avina. Oh, that makes sense, right? If initial NCI is equal to proportion of Avina, of course NCI does not receive a share of goodwill. This is identifiable net asset. What is goodwill? It is an unidentifiable item. Okay, so because NCI initial amount is equal to its proportionate share of subsidiaries Avina, therefore NCI does not receive a share of the goodwill. It is an unidentifiable item. Now, on the partial goodwill methods, you can see only parents' purchase goodwill is recognized. Now, let's look at the following example. Basically, same as the one we previously did. So, A acquired 60% shares in B and paid 150,000, and B's net asset or book value of the total equity is equal to 120,000. And all amounts were recorded at fair value, no fair value adjustment is required. Avina acquired by A, right, is equal to 220,000 multiplied by 60%. Right? Now, A paid 150,000, which is greater than Avina acquired, the difference representing the goodwill acquired by the parent entity, 18,000. That's all. So that is the total goodwill should be eventually presented in the consolidated statement as well, because NCI does not receive a share of any goodwill under partial goodwill method. Okay. Now, you can only determine NCI share of the goodwill when fair value of NCI is given in the question by applying the full goodwill methods. Now, it is possible in a question I give you, I may not specify the use of the partial goodwill methods, but you should know that is the only method you can use because NCI fair value will not be available. Okay? When that information is not available, then you are unable to apply full goodwill methods, but have to use the partial goodwill methods. Okay? Now let's look at the entries under partial goodwill methods. Start with the pre-acquisition entry, same as before, right? Same as before. So you can see the existence of the NCI does not impact your pre-acquisition entries. Or the choice of the goodwill method, again, does not impact on your pre-acquisition entries, right? They are same before. Now, then move on to look at NCI Step 1 entries. So here we allocate subsidiaries pre-acquisition share capital, retained earnings 40% to NCI. Now, this one is different from the previous one because under partial goodwill methods, NCI no longer receive any goodwill. So you can see the difference between the NCI on the partial goodwill methods and NCI on the full goodwill methods representing by the goodwill, right? NCI share of the goodwill. So the difference is actually just 7,000. So that is NCI, sorry, yeah, it's 7,000 NCI share of the goodwill. Now, because NCI does not receive any share of goodwill on the partial goodwill methods, you can see on the acquisition date, NCI equal to its proportion share of subsidiaries Athena, right? So what is B Limited Athena is 220,000. NCI share 40%, which is equal to 88,000. Now you can always verify this number, right, based on the goodwill method you applied here in the question. Now, so that's all our worksheet entries in relation to this practice. Now let's look at the next MCQ question. Chen Tao, Lin Chen Tao. Yes. Are we ready? You let me know which one you think that's right, okay? The last one, Chen Tao, you agree? The last one as well, okay? So on the partial good methods, well done. The NCA is measured at the NCS proportion share of Athena, right? So acquired is Athena. And on the partial good methods, NCI does not receive a share of the goodwill. So what's wrong with A? Only goodwill, that is wrong. Only goodwill acquired by parent will be recognized, not by NCI, okay? NCI measured at fair value. Now, if NCI measured at fair value, then NCI receive a share of the goodwill. So B is wrong, okay? And now C, goodwill will be recognized in valuation surplus. No, we don't recognize that in valuation surplus. Instead, we recognize as part of pre-acquisition entry, okay? All right, now let's look at the following calculation. Now, here the question asks for the partial goodwill methods. On the partial goodwill methods, the amount of goodwill acquired by One Limited. One Limited is a parent, right? It's a parent entity. The partial good method is relatively simple to apply compared with full good method. You just need to find two items, right? Consideration and then Athena acquired. C, let's have the different opinion. Yijun, Liu Yijun is not here today. Oh, sorry. Yeah, what do you think? Is that C as well, or different opinion? So you think it's D, the last one, okay? So let's look at which one is correct. Oh, it's C, D, very similar, right? Okay, so if you look at that two numbers, quite close. Okay, now let's look at the calculation. Now C is correct. Now, I believe you choose D, you probably forget to multiply something. It's either the 70% or forget to multiply 90%. I'm not sure in your calculation, you double check, okay? So you are going to compare consideration, which is given in the question, with Athena acquired. Now what is Athena? Athena is equal to the book value of subsidiaries net asset. We can reference to its equity balance on the acquisition date. Now include a share capital, 200,000, plus a reserve balance, 348,000. Okay. And then we have to think about if there's any fair value adjustment required here. Now, one of the items that is equipments in the record of subsidiary is 120,000 below fair value. So we need to prepare fair value adjustment of these equipments. So 120,000 then multiplied by 70%, your adjustment should be after tax adjustment, right? Now this is your fair value adjustment, net of tax. Then plus total equity, which is the book value of the subsidiary's net asset. Now you get Athena. Now, Avina acquired, we need to multiply 90% because parent only acquired 90% share of subsidiary Smith Limited, right? So compare Avina acquired with consideration transferred. Now, the difference representing the goodwill purchased by the parent company in the acquisition. Now, any question? Let me know. So far, so good? Okay. So two things, be careful, okay? Your adjustment for the fair value should be net of the tax. Okay, so many students doing their calculations, so they forget to multiply 70%. Okay. So in your quiz, right, or in the exam later, so make sure that when you write down, you just quickly write down your workings. When you double check your answer, you find, oh, I forget to multiply 70%, or I did, okay, and I also correctly multiply the percentage of parents' ownership interest in subsidiary to get Avina acquired. So these two might easily get messed up in the calculation. Yeah. So just be very careful. All right, now let's look at the calculation of the NCI. Now we only have learned the acquisition date NCI, but what about subsequent year after acquisition day? So how to determine NCI? So you can say NCI measured at their proportion of subsidiaries net asset, which in other words, NCI receive a share of both pre and post-acquisition equity of the subsidiary. Now here we talk about DNCI, okay? So DNCI receive both pre and post. Now if it's related to INCI, the INCI only receive a share of the post, okay? So we're going to extend our discussion of INCI on Friday, okay? All right, now so start with the DNCI. So you can see direct non-controlling interest get a share of pre-acquisition equity of the subsidiary. Now only DNCI, which means INCI, does not receive a share of subsidiary pre-acquisition equity. Now why not? We explained that on Friday, okay? Now then you can see post-acquisition equity movement of the subsidiary can be further broken down into two steps. So we first of all identify NCI share of the changes in subsidiaries equity balance from the acquisition day to the beginning of the current year. So this is related to post-equity movement to the beginning of the current year. That is from acquisition date to the beginning of current year. Identify the changes of movement. Now then we're going to look at the current year movement in subsidiaries equity. So usually resulting from current year profit and loss, current year dividend. So you can see the share of the post-acquisition equity of the subsidiary can be further broken down into these two steps. Okay. And the whole NCI calculation can be done in two stages. Now, what is your first stage? Now, in your first stage, we just allocate subsidiaries recorded equity proportionally to NCI. So including both pre and post. And this stage can be broken down into three steps. It's actually these three steps we previously described. First step, the NCI share of subsidiaries equity balance on acquisition day. So based on the subsidiaries pre-acquisition equity balance, we allocate that proportionally to NCI. Now, if full goodwill method applied, then you also allocate goodwill to the NCI. Now, then in the second stage, second step, still stage one, okay, but second step. In the second step, we look at the changes in subsidiaries equity balance from the acquisition date to the beginning of the current year. Now, usually you can find the changes in retained earnings, reserve accounts. Now, then moving on to the final step, that is step 3, we identify the changes in subsidiaries equity balance in the current year. And usually you can find the changes resulting from current year profit loss, current year dividend declared or paid. So this is a 3-step NCI calculation in your stage 1, okay, the stage 1. Now what about second stage? Now second stage, we are going to identify all the intragroup transactions. In the second stage, identify the intragroup transactions where subsidiary record the unrealized profit and loss in its accounts. And when these unrealized profit and loss are being eliminated in the worksheet, you need to adjust NCI accordingly. So it is very important in the second stage to identify the direction of the intragroup transaction. The direction matters. If it is a parent entity record the profit and loss that remains unrealized on the intragroup transaction, we only need to prepare intragroup elimination entries, no NCI adjustment. So we need an NCI adjustment that is subsidiary is a seller, and it is a subsidiary's record profit and loss that remains unrealized from the group viewpoint, from this intragroup transaction, that NCI need to be adjusted accordingly. Because NCI receive a share of the subsidiary's equity reflected in the consolidated accounts. So 3-step calculation in stage 1. Okay? And stage 2 NCI adjustment, whether required, depends on the direction of the intragroup transaction and depends on whether there is any unrealized profit loss in the record of the subsidiaries entity. All right, now, so this is a general format when you prepare your step 1 NCI entries. So you can see subsidiaries pre-acquisition equity balance, we need to allocate that proportionally to NCI. Now, on the full goodwill methods, we also need to recognize NCI share of goodwill. If partial goodwill method applied, then we don't need goodwill, right? So there's no goodwill allocated to NCI on the partial goodwill method. And on the full goodwill methods, NCI on the acquisition is equal to fair value, provided in the question. And on the partial goodwill methods, NCI on the acquisition is equal to its proportionate share of subsidiaries, Athena. Okay. All right, now let's look at this example. Now we start with parent company, P Limited, acquired 60% interest in S Limited. So there's a parent-sub relationship between these two entities. The remaining 40% shares in S Limited is known as NCI, right? Acquisition date is on 1st July 19, and the parent limited paid $60,000 in the acquisition. Now, on the same day, the balance of subsidiaries' equity accounts include share capital, a general reserve, retained earnings, total $62,000. Now, this is also equal to the book value of subsidiaries' net asset on the acquisition date, right? So these represent the book value of the subsidiaries' net asset on the acquisition date. Okay. Now, all assets are recorded at fair value, except for item of plant. Now, this item requires fair value adjustment. Now, by comparing the fair value with the carrying amount, so there are 20,000 difference, right? So 20,000 multiplied by 70%, so your fair value net of tax adjustment is 14,000. Okay. Now, the remaining useful life of the plant since the acquisition is 5 years. Now, why this is important? Because you have to consider subsequent year depreciation adjustment in your worksheet. Now, from the group perspective, the remaining depreciation amount of the plant is 200,000, right? And then divided by 5 years, so each year the group should recognize 40,000 depreciation expense. However, from the in the record of the legal entity, the subsidiary entity, the annual depreciation expense since the acquisition is 180,000 divided by 5 years. Now the difference is your adjustment. You can simply calculate your adjustment by using 200,000 minus 180,000, that is 20,000, right? So 20,000 divided by 5 years, each year we should adjust 4,000 of the depreciation. Right. Now what else we know? A fair value of NCI. Now with this information, you can apply full goodwill method. Now let's have a look at the entries on the full goodwill method first. Acquisition analysis on the full goodwill method first. Now in acquisition analysis, we combining the consideration paid with fair value of NCI. We got total 98,000. And then we're going to compare this amount with Athena to determine the total goodwill. Now how to calculate Athena is equal to the book value of the net asset reference to the equity balance of the subsidiary on the acquisition date. It's a recorded equity balance. Okay? So from the previous slides, it's recorded equity balance in the subsidiaries account on acquisition day, 62,000, that is represent its book value of net asset. Now, if all the subsidiary recorded items, they are identifiable items, then 62,000 is also equal to BV, the book value of the identifiable net asset. Okay. Now, only one item requires fair value adjustment. According to the question, the difference between fair value and carrying amount, 20,000, right? So 20,000 multiplied by 70%. Now, always remember that your fair value adjustment should be net of the tax. So fair value adjustment is 14,000. So 14,000 plus 62,000, Avena is equal to 76,000. Now compare this with 98,000, the difference representing the total goodwill acquired in the acquisition. So the total goodwill resulting from this acquisition. Then we have a look at the goodwill we should allocate to the parent. And these should be recorded in pre-acquisition entry, right? And the goodwill allocated to NCI, we recognize in step 1 NCI entry. Now, goodwill acquired by the parent, we can use the consideration paid by the parents minus Avena acquired. So consideration is given as 60,000. The Avena acquired is 76,000 multiplied by 60%, because the parents has acquired 60% shares in the subsidiary. Now the difference represents the goodwill purchased by parent entity. Now subtracting this from the total goodwill, you will get the NCI share of the goodwill. And the NCI share of goodwill recognized in NCI, step 1 NCI entry. Now this is our acquisition analysis. So any question, feel free to ask. Now let's look at, we had asked a question before, right? Whether the existence of NCI have any impact on RC entries? The answer is no. So you can see the RC entry remains same as previous discussed on the wholly owned subsidiary group structure. No change at all, right? Because the preparation of RC entry is to comply with ASB 3. So ASB 3 requires the fair value of the subsidiary's net asset that should be reported in your consolidated accounts, right? So we prepare the fair value adjustment in RC entry, and this fair value of the subsidiary net asset will not be affected by the existence of NCI. So whether parents acquire 90%, 80%, or 70% shares of the subsidiary is not going to change the fair value of those assets of the subsidiary, right? So that's why RC entry, same as before. There's no impact on RC entry. So you can see this RC entry is to adjust plant from its carrying amount to fair value, right? To fair value. Now let's recall the information in relate to this item. Oh, sorry about that. Here we go. The plant with original cost 250,000, carrying amount is 180,000. The difference represent accumulated depreciation, 70,000. Now, when you revalue non-current assets like property, plant, equipment, for example, the first thing you have to do, reset accumulated depreciation upon, right? Which in other words, you have to reverse its existing balance. So that's the reason why there is a debit of accumulated depreciation, 70,000, and there's a credit of plant, 70,000. But hang on, this is a credit plant, 50,000. Now that is because in the second step, you have a debit plant of 20,000. So combining credit plant 70,000 with a debit plant 20,000, that is a credit plant of 50,000. Okay. Now it's really up to you. Get 2 separate entries or a single entry. So debit plant of 20,000 is to adjust the plant from its carrying amount to fair value. So fair value is 20,000 above the carrying amount, right? Now then we recognize DTL. That is based on the revaluation gains of 20,000 multiplied by 30% tax rate. The net of tax revaluation gains is transferred to RC accounts, that is revaluation surplus on consolidation. Now, once again, this is not a general ledger account. So this is a worksheet account, the consolidation worksheet account. Now, its nature is quite similar to equity, but it is not a general ledger account. Now, then followed by pre-acquisition entries. So we prepare these entries to eliminate the parent's investment in subsidiary, and then we against the parent share of the subsidiary's pre-acquisition equity balance. Now remember, parent share here is 60%, so you need to multiply by 60%. So take RSA as an example. This is the RSA balance of the subsidiary, right? 14,000. Parents share 60% of 14,000, that is 8,400. So you only need to eliminate the parent's portion in the pre-acquisition entry. In addition to that, we recognize the goodwill acquired by parent, right? So according to our acquisition analysis, the goodwill attributable to the parent is 14,400, which is recognized here in pre-acquisition entries. Okay. Now up to here, nothing new, right? It's all based on the previous topics knowledge. Now let's move to look at NCI step 1. Now in the step 1 NCI entries, you need to allocate subsidiaries pre-acquisition equity balance, including share capital, general reserve, retained earnings, RSA, right? Let's multiply 40%, and we allocate it to NCI. Now in addition to that, we should also recognize NCI share of the goodwill. On the full goodwill methods, you can see NCI receive a share of subsidiaries goodwill, okay? Now then you get total credit of NCI for 38,000. Now these 38,000 can be verified. Now we have this information already. It's equal to fair value. Now remember that on the full goodwill method, NCI is equal to its fair value. That is based on the market value of shares not acquired by the parent. Okay. All right, now so that is our step 1 NCI entries on the full goodwill method. If partial goodwill method is used, we only need to find out the goodwill acquired by the parent, right? So goodwill acquired by the parents is equal to consideration minus FVNA acquired. What is the consideration? It's given as 60,000, right? FVNA is equal to the book value of the net asset, also equal to identifiable net asset, right? Plus the after-tax fair value adjustment for the plant, you get FVNA. Now FVNA acquired, we need to multiply 60% because parent only acquired 60% shares in the subsidiary. Now compare consideration with FVNA acquired, the difference representing the goodwill acquired by the parent. Now this is our acquisition analysis. So any question, let me know. Now moving on to our worksheet entries. So you can see RSA entry, same, right? So the RSA entry won't be affected by the existence of NCI, also won't be affected by the choice of the goodwill method. So all same as before, okay? Now in addition to that, let's prepare pre-acquisition entries, also same as before, right? It also won't be affected by the choice of the goodwill method. It doesn't matter partial goodwill method or full goodwill method, pre-acquisition entry remains same. Now step 1 NCI, now this one is different from the previous one. So you can see the allocation of subsidiaries pre-acquisition equity based on 40%. So these 4 lines same, but we no longer need to record any goodwill. On the partial goodwill methods, once again, NCI does not receive any share of the goodwill. So on the partial goodwill methods, NCI does not receive a share of the goodwill. And the NCI on the partial goodwill method at acquisition is equal to its proportionate share of subsidiaries FVNA. So subsidiaries FVNA is 76,000. We multiply 40%. That is your NCI balance on acquisition day. See, same, right? Which means most likely you debit allocation of the subsidiary pre-acquisition equity, have the right calculation. Okay. So try to verify this number, okay, to ensure you have the correct calculation in your entry. All right, guys, any question? Any question at this stage? No? No question? Okay, let's try this one. Now, partial goodwill methods. This, the last one. Okay, let's have a look at other opinion. Ying Chen, Mao Ying Chen, not here. Xiangqi, Xiangqi. The last one as well, okay? So you think two of you get the same answer. I believe that is the right answer. Now let's look at the calculation. This is on the partial good methods, right? We just need to find out the Athena. So that is a key, right? So question here asks for the NCA share of equity at the date of acquisition. And on the partial good methods, NCI on the acquisition date is equal to its proportionate share of Athena. So Athena is equal to the book value of the subsidiary's net asset. Reference to the equity balance, so we should use share capital 400,000 plus reserve 248,000. And then we're going to identify any item require fair value adjustment, right? So all the asset liability recorded by subsidiary equal to fair value except the equipments. And this item 120,000 difference between fair value carrying amount, so we need to make fair value adjustment. So based on 120,000 multiplied by 70%. So your adjustment always be net of tax. Now we got Athena, okay, and then multiply 10% because the NCI share is 10%. Okay, so 73,200. That is the right answer. Okay. Now, any other question? So this calculation. Now, I would classify this type of question as a simple one. Okay, so because you need to understand the level of difficulties in the exam question. Now, this will be classified as a simple question. Okay. All right, now, so that is all up to step 1. Oh, I think we should take a break. Now, so then after the break, we'll continue our discussion of step 2 and step 3, okay? So let's take a 10 minutes break. Oh, so coming back 4:30, okay? Oh, you have 12 minutes. Come back 4:30, and I will just finalize the group for group 1 and 3. So student from group 3, so I will just assign 2 of these to group 1. Okay, the group 1 you have 5 members. The other group same. Okay, the other group remains same. Don't worry about that. You already have member of 5. No need to worry anything. Okay, so it's just the group 1 and 3. So I need to consolidate that 2 groups. Oh, sorry, group 1 and 6, not 3. Okay, sorry. 1 and 6, 1 and 6. I just keep thinking about 3 is the number of students left in that group. Team 2, I just give me a second. Sort this out first. Give me 2 minutes. Come back in 2 minutes. Yupei and Songyao, can you check I have make the change. Can you check from your side if that is correct? Okay, so it should be team 1 now. Okay, so has anyone asked for team 2? Okay. Oh yeah, so you're in team 2, right? So do you know other people in your group? Oh, team 2, yes, I signed the new members. Ruoqi, I will send email to Ruoqi and CC that to you. Is that right? So what's your name? Sorry. Song Zizhou, right? Yeah, I will CC that to you. And you pass this information to the rest of the members in your group, okay? Is Ruoqi here today? Ruoqi? Zhang Ruoqi? No? So can you check your email? Yeah. And you will have her email address at the same time. So it's student's email address. Oh, yes. Of course.
Minus, that's right. Ignore that because it is not identified by what is a workforce. Human resource, right? It's not identified. Ignore that. Okay. So what happened here? You don't have power. You only have protection, right? Is to protect your interest. When there is no power, which means there is no parent-subsidiary relationship. So you can see parent-subsidiary relationship does not exist because these two parties, no spec only have protective right rather than substantive right. Okay. Now for this one, you can see they all have 1/3. There are 3 members, right? They all have an equal portion. So which means no one can have a control, right? But one of the investor has a call option, which means if this investor exercises a call option, he can buy shares from others. Then he will become the sole shareholders, right? The only investor in that company obtaining the control. Well, of course, this is based on the assumption that is in the money option. Exercise the option, you get benefits rather than making a loss. And then the measurement ABC does not impact that. This doesn't matter. Whether you decide to exercise or not is not going to affect that you have the current ability. Okay? Good. Thank you.
All right, now let's continue our discussion of NCI subsequent to acquisition date. Now we're going to move on to step 2. Now the main purpose of this step is to identify the movement in the subsidiary's equity balance from the acquisition date to the beginning of the current year. Okay. Now usually you can find such movement in retained earnings or reserve accounts, including RSC accounts. Okay. Now then, we allocate these changes subsidiaries equity balance proportionally to NCI, okay? And be very careful. The opening post-equity earnings might require to be adjusted due to the subsequent year fair value adjustment, including the depreciation adjustment occurred in the prior year worksheet, okay? Now let's look at the general format. Now here we are assuming the positive changes in retained earnings reserve has been identified. Now we allocate that proportionally to NCI. So assuming the positive changes, the beginning balance of current is greater than the acquisition date balance, then you have these 2 lines on the debit side. Otherwise, you switch the debit credit sign. Okay. Now you also have to consider this is actually related to the stage 2. So where some unrealized profit loss in the recall subsidiary. These intergroup transactions occurred in the prior year, and this profit and loss remains unrealized at the beginning of this year. Okay, this is related to the stage 2. Now this one is related to the fair value adjustment, like a depreciation adjustment required in the worksheet. So due to the amount of depreciation in the recall subsidiary is understated from the group viewpoint. Okay, and the effect of those adjustments occurred in the prior year need to carry over to the current year and require adjustment to the opening retained earnings of the subsidiary. Now we're going to have a look at all these situations in our example. So we're going to continue on from the previous example. Okay, now we have done acquisition date. Now let's look at the worksheet entries subsequent to the acquisition date. Now assuming current year ended on 30 June 22, let's also assuming the partial good method is used here in the worksheet when you prepare the worksheet entries on 30 June 22. Okay. Now this is your subsidiary's acquisition date recorded equity balance. That is the pre-acquisition equity balance. Okay. And this is the balance at the beginning of the current year because current year ended on 22, right? 30 June 22. So the balance on 30 June 21, these represent opening balance of the current period. And this is a closing balance. Okay. All right. Now, so what else we need to know? Let's recall one of the assets in the recall subsidiary is understated compared to its fair value, right? So you can say fair value is 20,000 above the carrying amount. Okay. And you need to prepare fair value adjusting entry, the RSC entry for this item. Now, in addition to that, also you have to think about the subsequent year depreciation adjustment. So you can see the total difference between fair value carrying amount is 20,000, right? And these 20,000 will be adjusted over 5 years through depreciation adjustment. So 20,000 divided by 5 years each year, we need to prepare 4,000 depreciation adjustment in the worksheet. And now you are at 30 June 22. Now you also need to carry over the effect of prior 2 years depreciation adjustment to the current year worksheet. The prior 2 years, year 20 and year 21, right? The prior 2 years depreciation adjustment is in fact need to be carried over to the current year worksheet. Now let's look at our worksheet entries. Now RSC entry is same as before. Now as long as these equipment still in the record of the subsidiary, now you are going to repeat the same RSC entries in the worksheet every year. Now that is for 5 years, right? That's going to be for 5 years. And now this is actually the 3 years since the acquisition date. So the item still in the record of subsidiary, so we just need to repeat the same RSC entries as you have previously done in your worksheet on acquisition date, the same, right? But in addition to these RSC entries, we also have to prepare depreciation adjustment for the item, for these assets. Now you can see there are extra depreciation adjustment required every year in the worksheet, right? Every year. Now each year you adjust for 4,000. But you also have to carry over the effect of prior 2 years adjustment. And the prior 2 years adjustment contained in prior 2 years worksheet which its effect will not be carried over to the current year, right? And the prior year depreciation expense already close to retained earnings. Therefore, you need to debit opening retained earnings for 8,000. So these represent year 1 and year 2, which is year 20 and year 21 depreciation adjustment. And your accumulated depreciation should reflect 3 years of your adjustment, because already year 22, right? Your acquisition date is 1st July year 2019, 19 up to 22, that is 3 years. Now then we're going to show tax effect of your adjustment. Now depreciation expense increase, which would decrease the group profit, right? And therefore decrease the income tax expense of the group. 30% of 4,000, there is a credit ITE for 1,200. You also need to carry over prior 2 years ITE adjustment, which is based on 30% of prior 2 years depreciation adjustment, right? So 30% of 8,000, your credit return earnings of 2,400. So this represent prior 2 years ITE adjustment. We carry over its effect to the current year by adjusting the opening retained earnings. Which entity's opening retained earnings here? Subsidiary, right? Because the IT is used by subsidiary, and it is subsidiary's recorded depreciation is understated compared to the group. And therefore, these two-line adjustment, debit retained earnings 8,000, credit retained earnings 2,400, that effectively reduce the opening retained earnings of the subsidiary by 5,400. So subsidiary's opening retained earnings reduced by 5,600. Okay. All right. Now, so this is your depreciation and ITE adjustment in relation to these assets. Now, then we're going to move on to look at pre-acquisition entry. Now, this is the same as before, right? Same as on acquisition date. The pre-acquisition entry remains same because there is no transfer between pre-acquisition retained earnings and reserve subsequent to that acquisition date. Right? And there's no goodwill that has been previously impaired, so we just need to repeat the exactly same pre-acquisition entries as you have previously prepared in your worksheet on the acquisition date. All right, now then step 1, NCI calculation, same as before, right? Assuming partial goodwill method is used. So in your step 1 NCI entries, we allocate subsidiaries pre-acquisition equity balance proportionally to NCI. And this NCI balance here, 30,400, is equal to its proportionate share of subsidiaries Avina. All right? So we have verified that in our previous records. Now, then this is additional depreciation adjustment in relation to the assets recorded by subsidiary, right? And these two-line adjustment of the opening retained earnings reduce the subsidiary's retained earnings balance by 5,600. And we should take these adjustments into account when calculate the NCI share of the post-equity retained earnings in the second step. Okay? Now, based on the subsidiary's recorded opening retained earnings, 45,000 minus its acquisition retained earnings balance, 20,000. So you can see there is a movement in the retained earnings from the acquisition to the beginning of the current year, that is 25,000. But this amount need to be adjusted. Why is that? Because of these two-line adjustment in your RSC entry, right? So these two-line adjustment effectively reduce the opening retained earnings balance of the subsidiary down by 5,600. So you can see the subsidiary's opening retained earnings, this balance reduced by this amount, right? Right. So then we find that the adjusted opening post-acquisition retained earnings, so just take these 5,600 from 25,000, you will get this number. Right. Now then we allocate this proportionally to NCI. So you can see the number here is a positive, which means NCI increase, right? So NCI increase, we credit NCI and debit retained earnings opening balance. So you can see here, NCI increase because NCI receive a share in the post-acquisition retained earnings. Okay. Now, if the number here, you got negative figure, then you're just switching the debit credit sign. Never debit credit a negative figure. That is absolutely wrong, okay? So always remember to find the correct debit credit sign when you're recording the entry. Now, what else we find? Let's have a look at the question again. Now, share capital same, right? No changes in the share capital. General reserve increased by 1,000. Now, this one, we need to show NCI share, right? So the increase in the general reserve will also result in increase of NCI share of changes in general reserve according to NCI interest 40% multiply 1,000. Now these two entries can be combined, okay? So you can combine these two entries, debit retained earnings, debit general reserve, and credit NCI for the total of 8,160. Now this is our step 2 NCI calculation and entries. So anyone got question? Let me know if you got question here, okay? Now let's move on to our final step in our stage 1 NCI calculation. Now in this final step, we are going to identify the changes in subsidiaries' equity balance in the current year. Now you can usually find the movement which is resulting from current year profit and loss reported by the subsidiary, current year dividend declared or paid, and the director of the subsidiary may announce a transfer from retained earnings between retained earnings and reserve. But this one does not apply here, okay? So we don't actually have this condition included in our example here. All right, now, so if there is a profit reported by the subsidiary and NCI record the share of that, so we debit NCI share of profit, credit NCI. Now, what if we recognize NCI share of subsidiary's loss? Then we debit NCI, okay? So if there's a loss reported by the subsidiary and NCI records share of the loss, then you debit NCI and credit NCI share of loss. Okay? Now, and when subsidiary pay out dividend, its equity reduced, therefore NCI decrease. So definitely a debit, okay? So NCI decrease. But in compensate, these parties receive a cash dividend from the subsidiary. Okay? It's more like a return of their investment. All right, now, so then we're moving on. Oh, be careful with this line. Now, dividend payable related to NCI or dividend income recognized by the NCI are not eliminated here because NCI is not part of the economic entity. The economic entity only comprises of the parent and all its controlled subsidiary, okay? So yes, NCI is an equity contributor to the group, but NCI is not part of the group. So therefore, any dividend related to the payable related to NCI does not need to be eliminated. Only the dividend that is declared and paid by subsidiary to the parent's company required to be eliminated. Yeah. All right, now let's go back to our question. Subsidiary reported after-tax profit 40,000 and paid 10,000 dividend. Okay. Are we going to simply allocate the 40,000 profit to NCI? Of course not, right? So you can see we should include the following adjustment. Now, where this adjustment comes from? Now, if we go back to our RRC entries one more time, here we go. You can see in the current year worksheet, we prepare adjustment of the depreciation, right? And ITE, okay. Now, these two-line adjustment effectively reduce the profit that subsidiary contribute to the group. Why is that? Because it is a subsidiary's recorded depreciation that is understated compared to the group viewpoint. And that is the reason why we need to make adjustment in the worksheet, right? And these adjustments then reduce the after-tax profit of the subsidiary, that is 2,800. So using 4,000 minus 1,200 tax. Now, you should take these adjustments into account before you allocate the subsidiary's profit to NCI. So you can see the adjusted profit of the subsidiary then will be reflected in your consolidated accounts, right? So using reported profit 40,000 minus the depreciation adjustment in relate to the assets used by subsidiary, right? So adjustment effectively reduce subsidiary's profit by 2,800. So subtract these from 40,000, you will get adjusted current year profit of the subsidiary. Then we allocate that proportionally based on 40% to NCI. Because NCI receives a share of the profit in this example, we credit NCI and debit NCI share of profit. So anyone got a question? Feel free to ask. Now, then you may wonder, what about dividend 10,000? Now let's have a look at dividend in the second stage, because this dividend paid by subsidiary resulting intragroup dividend. So we are going to have a look at these dividend entries in the second stage. Okay? All right, now let's move on to look at the following MCQ exercise. Now, if I were you, I would directly jump to the requirements first, because it takes time to read the whole paragraph, right? So you need to know what these questions ask you to do, and then go back to the question, find the relevant information. And not all the information contained in your question will be applied or used to get the final result, okay? So the question you ask for the total share of NCI in equity of Grain Limited at the end of the current period. Now you can try the three-step method we have just learned, okay? And then I will give you the alternative methods later, okay? So try the three-step methods to get the answer. Chen Yu, Shi Chen Yu, not here. Song Yao, get the answer. The last one, D, okay. Thank you, and I will ask one more. Chang Yi, Wang Chang Yi, yeah. Do you agree, D? Not yet, okay. Hongren, Wang Hongren, yeah. Which one you choose? C, okay, so we have a different opinion. Xing Chen, what do you think? You choose D as well. Okay, I got two students choose D, one chooses C. Let's look at the calculation. D is the right answer, okay? So let's have a look at the step involved in these calculations. Start with step NCI share of the subsidiaries pre-acquisition equity balance. That is step 1, right? The subsidiaries pre-acquisition equity balance include the share capital, 100,000, and 20,000 retained earnings. So in total, 120,000. Then we multiply NCI interest here is 25%. Okay, this is step 1. Now step 2, let's look at the changes in subsidiaries equity balance. Now share capital is same, right? The changes is resulting from retained earnings. So you can look at the equity retained earnings opening balance is 80,000, and minus the balance on acquisition date. So the change is 60,000, right? Then 60,000 multiplied by 25%. So we allocate to NCI. Okay. Then moving on to step 3. So current year movement increase. So you can see current year profit increase subsidiary equity by 40,000. But the current year dividend paid decreased the subsidiaries equity by 10,000. So you can see the net changes in subsidiaries equity in the current year is 30,000, right? So 30,000 times 25%, or we can do that separately if you want to, doesn't matter, okay? Then total this up, you will get 52,500. But you don't really have to apply all the 3 steps to get these calculations done, okay? Now I'll show you how to do that quickly. NCI share of the equity of this subsidiary, right? On the acquisition, at the reporting date. Now remember that NCI receive a share of both pre and post acquisition equity of the subsidiary, both pre and post. So in order to find out that this is only related to DNCI, okay? But we here only talk about DNCI today. So in order to find out is the share of a subsidiary's equity balance at the end of the current year, all we need to do is to find out subsidiaries' equity balance at the end of the current year, right? And then we multiply 25% to get NCI share. So what is subsidiaries' equity balance at the end of the current year, including share capital balance, 100,000, right? Now what about retained earnings balance? So what is the subsidiaries' retained earnings balance at the end of the current period? Now you have beginning balance, 80,000, right? And increased by 40,000 because subsidiary called a profit, and decreased by 10,000 because subsidiary pay out dividend. Okay. So you can see its retained earnings closing balance is equal to 110,000, right? The retained earnings closing balance is 110,000 plus 100,000 share capital. The total equity of the subsidiary at the end of the current year is 210,000. Then 210,000 multiplied by 25%. 210,000 multiplied by 25%. So you have the calculator. Here we go, calculator. Multiply by 25%, right? So we got 52,500. So you don't have to apply all the 3 steps, as long as you understand, right? NCI, DNCI here receive a share of both pre and post equity balance of the subsidiary. So in order to find out NCI share of the equity balance in the subsidiary, so we just need to find a subsidiary's equity balance at the reporting date, right? That is share capital plus retained earnings. And then we allocate that proportionally, so here based on 25% to NCI. That's it. Okay. All right, now let's move on to have a look at the final issues we are going to deal with here is the stage 2 NCI adjustment. Now whether we need a stage 2 NCI adjustment actually depends on who is the seller, right, in this intragroup transaction, and whether there are any unrealized profit loss in the record of the subsidiaries accounts by the end of the current year. Okay. Now the existence of NCI have no direct impact on elimination entries we have learned in the previous session. Okay, so you can see according to ASB 10, full elimination is required. So you have to eliminate in full all the intragroup asset, liability, revenue, expense, equity, now regardless of the parent's ownership interest in the subsidiary. But you need to pay attention to the dividend, because the full effects of dividend depends on the parent's ownership interest. Now, if the parents, for example, own 60% shares in the subsidiary, when subsidiary pay 10,000 dividend, only 60% of 10,000 dividend, which is 6,000, is received by parents and will be regarded as an intragroup dividend revenue. Okay? The dividend paid or declared to NCI is not an intragroup. So the intragroup dividend is related to the dividend paid or declared by subsidiary and received by parent entity. Okay? So you can see the full effect of an intragroup dividend depends on the parent's ownership interest. But for all the other intragroup transactions, we don't need to worry about the ownership interest parents has over the subsidiary. Okay? It doesn't matter whether it's 80%, 60%, the same elimination entry is required to be prepared. Okay? Same as we did previously. Now then, what about NCI adjustments? As I said, not all the intragroup transactions result in a further NCI adjustment. Right? So you have to pay attention to the direction of the transaction. Which entity record the unrealized profit loss on these intragroup transactions? Okay. Now for the NCI, the NCI will be adjusted if it is a subsidiary entity as a seller, right? Record the profit loss from these intragroup transactions. And those profit loss remains unrealized. It must be remain unrealized from the group viewpoint. Okay? And then required to be eliminated in the worksheet. And these elimination entries will result in further NCI adjustment, because the elimination entries you prepared in the worksheet effectively affects the equity that subsidiary contribute to the group, and therefore require NCI adjustment. If the unrealized profit loss are recorded in the book of the parent, we only need to prepare integral elimination entry. There's no NCI adjustment. Okay, so keep in mind, NCI receive a share of the subsidiary's equity that reflected in the consolidated accounts. If the unrealized profit loss is in the record of the parent, your elimination entry affects the parent's equity that reflect in your consolidated accounts. And that's why NCI does not need to be adjusted. Okay? Now let's have a look at the summary here. So you can see intragroup transaction where subsidiary make an unrealized profit or loss. Okay? Then elimination entries will effectively remove the effect of these unrealized profit loss and require NCI adjustment. You can see you must result in the subsidiary, so the intragroup transaction must result in a subsidiary entity recognize the profit loss, and these profit loss remains unrealized. So you can see intragroup services, intragroup borrowings, where there is no unrealized profit from such transaction, right? These transactions have no impact on NCI. Okay, so the transactions only relate to intragroup transfer, for example, inventory, or intragroup transfer PPE, and the seller must be the subsidiary entity. Now, once this profit loss is eliminated, unrealized profit loss is eliminated on the worksheet, then NCI share of this profit loss should also be adjusted accordingly. Okay. Now, if it's a transferred PPE, if the unrealized gains is initially recorded in the subsidiary's accounts, and these unrealized gains will be realized progressively through the use of this asset by adjustment of the depreciation. Okay, so we're going to show you an example to demonstrate this adjustment in the worksheet. Now, general rules, so you can see if the elimination entry reduce subsidiaries, currently a subsidiary's profit, then we debit NCI decrease because NCI share of subsidiary profit also decrease, okay? And if the unrealized profit is realized in the current year, then as a result, subsidiary current year profit increase, then we need to debit NCI share profit and credit NCI. Okay. Now we're going to have a look at the following example. So the transaction date, that is very important because you first of all have to identify when this transaction took place. Is it a current year transaction or prior year transaction? Now, assuming current year is ended on 30 June 22, so is it current year transaction or prior year transaction? Current year or prior year? It's prior year transaction, right? So it is in the previous year. Seller is Us Limited, that subsidiary entity, sold inventory parent for 100,000 at a profit before tax of 20,000. Now you can see there's 20,000 profit in the record of subsidiary in the prior year from the intra-group transaction, and this 20,000 remains unrealized by the end of the last year because all inventory is still on hand, right? It's unsold, which means this 20,000 profit remains unrealized from a group viewpoint. And you need to prepare the worksheet entry to eliminate this unrealized profit on 30 June 21. Now then this unrealized profit now is included in the retained earnings of Us Limited at the beginning of the current year. So you have, but should be after tax basis, right? So because prior year sales revenue, cost of goods sold, ITE all close to retained earnings. So the opening balance of retained earnings for Us Limited contains this unrealized profit resulting from prior year sale of the inventory from Us to P. So the after-tax unrealized profit contained in opening retained earnings, that will be 14,000. So your elimination entries start with a debit of retained earnings, 14,000. Now, when this inventory is sold to the outside party, now that is according to the question, it is sold, right, before the end of the current financial year end. So it is sold to outside party, then adjustment is made to cost of goods sold. So the cost of goods sold should be reduced by 20,000 because it is overstated, right, from the group viewpoint. Now, then we debit retained earnings is to eliminate the unrealized profit after tax basis contained in opening retained earnings because end of the last year, the inventory transferred from the subsidiary parents remains unsold. Now, in the current year, when this inventory is sold to the outside party, the unrealized profit contained in opening retained earnings now is realized in the current year. So when it's sold to the external party, the unrealized profit now is realized. So you can see current year after tax profit increased by 14,000, right? The current year group after tax profit increased by 14,000, okay? Now this is your elimination entries. You need to prepare NCI adjustment because the unrealized profit is included in the record of the subsidiary, okay? And this adjustment effectively reduce subsidiaries opening retained earnings by 14,000, and that's why NCI share of subsidiaries opening post-equity retained earnings should also decrease. So that is based on 40% of 14,000. In addition to that, because unrealized profit now is realized in the current year profit increase, then NCI share of current year profit should also increase. You may already notice there's no overall impact on the NCI. Right? Combining these two entries, there will be a debit of NCI share profit, credit retained earnings. Because NCI share of retained earnings, that is step 2, right? Decrease. But the NCI share of current year profit in step 3 has increased by same amount. So you can say debit NCI, credit NCI even up. Okay? So you can just combine these two entries, record these two lines only. Now let's change this question a little bit. What if it is a parent's company sold inventory to subsidiary, all the other conditions remain same. What will be your worksheet adjustment? This part, same, right? It doesn't matter who sell to whom. So things matter here is to find out the intragroup profit loss, right? Parents sold to subsidiary, subsidiary sold to parents. Well, we have the same elimination entry. But do you need NCI adjustment? Not anymore. If the unrealized profit is initially recorded by parent entity, the parent is considered as a seller, then you only need to prepare the elimination entry to remove the effect of the intragroup transaction. No NCI. Okay, so the elimination entries here affect the parent's equity balance rather than the subsidiary. Then no NCI is required. No NCI adjustment is not required. Okay. All right. Now, so let's move on to look at dividend. Now, remember that subsidiary paid 10,000 dividend. Right? Parents' interest in subsidiary is 60%. Therefore, parents record a dividend revenue, 6,000, and that is your intragroup dividend revenue. So paid by subsidiary, received by the parents, they are in the same group, right? So that is intragroup dividend revenue. The eliminate entry is prepared here to remove all the intragroup dividend revenue. So by debit dividend revenue, credit dividend paid. So, well, what about the other 40% dividend paid by subsidiary? Now, these will be received by NCI, right? And when subsidiary pay out dividend is equity reduced, NCI share of subsidiaries equity balance also decrease. Right. So this is, you can record this as part of step 3 NCI. That's fine. Rather than putting down here, you include that in part 3, step 3 NCI. That is better. Okay. And the elimination of this dividend revenue simply reduce the profit of the parents. Has nothing to do with NCI, right? But when this party directly receive cash dividend from the subsidiary, then adjustment entry is required. So to debit NCI, NCI decrease, as a subsidiary's net asset decrease. All right, now let's look at the following MCQ. Second one, okay, so let's look at other different opinion. Yupei, Wang Yupei, yeah, what do you think? The second one as well? Okay, now what if I change my question, say it's a one limited sell to Dika, parent sell to subsidiary, then what's your answer? That will be 0, right? Okay, so be careful. Who is the seller here? Okay, now very good, well done. So we actually get the correct answer here. So B is the right one. So let's look at the calculation. Now, first of all, we need to find out the unrealized profit from this intragroup transfer item. Now, this transaction took place in the current year. Okay? Now, intragroup selling price 30,000, original cost is 26,000. So there are 4,000 profit recorded by subsidiary, right? Recorded by subsidiary when sell the item to parent. Now, are these 4,000 profit realized? No, not realized, right? They all on hand, remains unrealized. Okay. Now, what is our NC adjustment? So you can see the 4,000 is a before tax profit. After tax profit, 4,000 times 70%, so 2,800. So the elimination entry you prepared will effectively reduce the profit that subsidiary contributed to the group down by 2,800, right? And when subsidiary's profit decrease, NCI share of the profit should also decrease. And that is based on 2,800 multiplied by 20%. Now, first of all, you need to make sure you can prepare elimination entry, right? The elimination entry to remove the effect of intragroup transaction. So how to prepare elimination entry for this one? So what is the appropriate elimination entries here? Debit? Oh, hang on. This happened in the current year. It's a current year transfer. The profit is not accounts, debit sales. Right? The profit is not accounts, okay? So profit is not general ledger account. Your debit sales, 30,000, right? Credit, inventory, credit, cost of goods sold. Now, what is the credit of inventory? 30,000 minus 26,000, that is 4,000, right? And this 4,000 profit remains unrealized. Then inventory should be adjusted down by 4,000. And the balancing figure, credit cost of sale, 26,000. Anything else? Did I miss out anything? Tax, right? Don't forget tax. So then we debit DTA, credit income tax expense, based on 30% of 4,000, which is 1,200. Yeah. Now you can see these elimination entries reduce the after-tax profit by 2,800. So using 30,000 sales minus 26,000 cost of goods sold, right? And then minus income tax expense 1,200. So the after-tax profit of 2,800, which remains unrealized, now is eliminated in your worksheet. The profit decrease, NCI share of the profit should also decrease. That's why you have a debit NCI, credit NCI share profit. Remember, NCI is equity accounts. Debit means decrease. Why decrease? Because the NCI share of the consolidated profit decrease. Now, if the question told you, oh, subsidiary sell to parent, this is subsidiary sell to parents, right? This is your answer B. If it's a parent's sells inventory to subsidiary, you don't need to do any further calculation. NC adjustment, 0. Okay. All right, now let's look at the next one. Wei Yuting. Yeah, did you get your answer? The second one, increase or decrease? That is the question. Increase or decrease? Decrease. So D, right? So D shows a decrease. Yu Yao, Wang Yu Yao? Not here. Xue Ming? Yan Chen? Yan Chen? Zimu? Do you agree? D, the last one. Okay. All right. So we agree D, right? Decrease. Now, why is there a decrease? Now, if you look at the question here, now John owns 75% of one. So one is a subsidiary, right? And the transaction took place on 1st July 21, which is the beginning of the current year. So it is a current year intragroup transfer transaction. And the seller is a subsidiary. Now, subsidiary sold equipment to Jones at a profit of 30,000. Now, that is before tax, right? So after tax, profit from this intragroup transfer item is 21,000. Now, they are unrealized profit, right? If you look at the situation immediate after transfer. So immediate after transfer, all these 21,000 after tax gains on sale remains unrealized. Now, when it becomes realized? Through the use. Okay, so you can see the remaining useful life of the equipment since the transfer was 5 years. Therefore, each year, so we can use 21,000 divided by 5 years. So each year, the unrealized gains will be realized proportionally, right? So based on the calculations, 4,200 each year. Okay, so each year realized by 4,200. Now, immediately after transfer, the total unrealized profit after tax is 21,000. Now, 4,200 is realized in the current year because at the end of the current year, you need to adjust 1 year depreciation. And through depreciation adjustment, part of this profit will become realized, right? So the total unrealized profit by end of the current year, so we use 21,000 minus 4,200 already realized, so the remaining unrealized profit is 16,800. Now, so your elimination entry therefore effectively reduce the group profit by 16,800 because they are remaining unrealized profit and required to be eliminated. Okay. Now, what is the NCI share? NCI share is 25%. So you can say NCI share of the current year profit should decrease by 4,200. Okay. Now, what about next year? Next year, there will be an increase. Okay, so the answer increase will be correct if I ask for NCI share profit for year ended 30 June 23. Right, for year 20, because 23 adjustment, well, another profit 4,200 will be realized, and the NCI share of that will also be realized, right? So, oh, sorry, not 4,200, but 4,200 multiplied by 25%. Okay. Just be very careful. Now, it's very important we need to understand that the unrealized profit will, for transfer PPE, right, will be realized progressively through the use of the item by adjustment of depreciation. Okay. Now, if the seller is a subsidiary, then it is a subsidiary's equity account will be affected by those adjustments. If the seller is a parent, then you will have the same elimination entry to remove the impact of this intragroup transaction, but no NCI adjustment is required. Right. So you can see it is very important to identify the direction of the transaction first. If the question here asks for the impact of this transaction on NCI. Okay. Now, in your second technical assignment, you don't need to worry about NCI. Okay. So we focus on elimination of the intragroup transaction only. Now, so that's for the topic 6. Okay, so topic 5. Now, topic 6. Now, this one is the most challenging one. We are going to have a look at multiple subsidiary group structure, and also we're going to learn how to calculate INCI. So the rules principle applied for the calculation of INCI is different from DNCI. Okay, it's a bit different. And also look at multiple subsidiaries. So we like to know how we are going to use our consolidation methods. So are these same as for only one subsidiary, or they are actually any difference between a single subsidiary or multiple subsidiaries? So we're going to have a look at that in topic 6. Now, this topic is a bit more challenging compared to other topics, so I'm hoping you can do some preparation before the next week's not next seminar, not next week, on Friday, okay? But we do actually reschedule our class on 26th of January, because 26th January is a public holiday. So we have rescheduled the class on the following Monday. So you can check the schedule, okay? So we already update the information on Moodle, and you can also find that information in our course introduction slides, okay? So where I am, oh, here we go. Now let's look at the in-class question here. Now in this question, ABC Limited acquired 80% of DEF's voting shares. The NCI in DEF is 20%. Okay. The acquisition date is 1st July year X1. What is reporting date? Let's have a look at that first. Now the current year ended is 30 June year X2. So it's just 1 year, right? 1 year since acquisition date. Okay. Now parents entity paid 2.4 million to acquire 80% shares of DEF. And on the acquisition date, DEF has a share capital balance of 2 million, retained earnings of 500,000. So you can see the book value of DEF's net asset on the acquisition date is 2.5 million. Okay. Now, all the assets of DEF are recorded at amount equal to fair value except for these equipments. Now, these equipments therefore require fair value adjustment. So when you compare the fair value with the carrying amount, the difference 300,000, right, is your fair value adjustment multiplied by 70%. Now, remember, adjustment is always after the tax. Now, because the equipment is a depreciable item, you also have to consider subsequent year depreciation adjustment. Right? So depreciation adjustment each year equal to 300,000 divided by 10 years, right? So 300,000 divided by 10 years. Right. Now, in addition to the above, internal auditor identified the following unrecorded asset liabilities, okay? So including trademarks, okay? So with a fair value of 130,000, okay? And contingent liability in relation to the lawsuit, assuming the existence of the present obligation. Okay? And the fair value of these contingent liability is 30,000. So what is the fair value of a liability? That is the amount the third party would pay to settle that liability, which is 30,000 in the question. Okay? Now, finally, ABC incurred legal fees, accounting fees. Now, these are acquisition-related costs and should be expensed immediately as incurred because the benefits has already consumed, considering the service has already been received by the parent entity. Okay? So these should be recorded by the parent company as expense when incurred. Now, fair value of NCI on the acquisition is given as 600,000. Now, with this information, we can apply full goodwill method. Okay? And during the year ended 30 June X2, so that is the current period, subsidiary reported a profit after tax profit of 120,000 and paid 50,000 dividend. Now, this relates to your step 3 NCI calculation. Now, let's move on to look at the requirements. Now, determine the fair value of DEF's net identifiable assets. So that is AFINA, right? The calculate AFINA. The AFINA of the subsidiary is equal to its book value of the net asset, book value of the identifiable net asset, right? We simply just reference to the equity balance of the subsidiary on acquisition date. Okay, so 2.5 million. Okay. Now then we are going to identify all the fair value adjustment for the asset and the liability, including equipments. Fair value is 300,000 above the carrying amount. So using 300,000 multiplied by 70%. Keep in mind, adjustment should be after tax. Okay. Now, trademark is easily generated, therefore not recognized by the subsidiary. Okay. They're identified in the acquisition, so we record it's a fair value of 130,000 and then multiply 70%. Contingent liability with a fair value of 30,000 multiplied 70% reduce the AFINA, right? So liability increase, reduce the net asset. Right. Now, adding these together, all these together, you will get AFINA. Okay. Now, this is our first requirement, calculate the fair value of subsidiaries identifiable net asset on the acquisition date. Now, anyone got questions? So let me know, okay? Now, then moving on to look at the second, determine the value of goodwill using full goodwill method. Now, when applying the full goodwill method, we need to know fair value of NCI, right? So consideration transfer plus NCI fair value. Consideration transfer plus NCI fair value, you get 3 million. And then compare that with Athena. Not Athena acquired, Athena. Okay? So the fair value of subsidiaries identifiable net asset. Okay, compare that with Athena. Okay. Now the difference representing the goodwill. Okay. So that is a total goodwill resulting from this acquisition. Now this total goodwill is comprised of two parts, right? Parents' share and NCI share. So how do you find out the goodwill purchased by the parent? Now we can scrolling down to part C, okay? So you can see using consideration minus Athena acquired. Now we already know Athena from our part A, right? 2.78 million. So Athena acquired is Athena multiplied by the parent's ownership interest, that is 80%, which is Athena acquired. Now consideration minus Athena acquired, the difference representing the goodwill acquired by the parents. Now if you subtract this number from the total goodwill, 220,000, then the difference represent the goodwill we allocate to NCI. Okay, so it depends on the requirement in the question. We may ask you to determine the NCI share of the goodwill on the full goodwill methods, or we may ask you to calculate the goodwill acquired by the parents, right? Well, the goodwill acquired by the parents doesn't matter you're applying partial goodwill method or full goodwill method, same, right? Well, if the question here asks for the total goodwill, then it is a total goodwill resulting from the acquisition, 220,000 should be used. Now, any question from this practice? A, B, C. Is there any question at this stage? Okay, so let me know if there's any question, okay? Now, the final requirements, so you can look at the requirement D, right? So requirement D, prepare consolidation journal entries for 30 June year X2, assuming partial goodwill methods is used here, okay? Now, assuming partial goodwill methods is used, so NCI does not receive a share of the goodwill, okay? Now, let's look at our RC entry first. Now, you might notice that it's a RC entries combining all the equipments, trademark, sorry, I forgot to change these accounts. Change that to provision for legal claims, okay? So use provision, the payable is not appropriate. It's not appropriate, okay? So we should raise a provision. So I will update this information before I release that, okay? Now, provision for legal claims. Okay? So it's actually a combination of 3 RC entries, okay? So well, better recall that separately, right? So for equipment, for example, there will be a debit of accumulated depreciation. Oh, I don't have that. So there's no accumulated depreciation information. I only know the carrying amount. Then that's fine. Then we just only have a debit equipment for 300,000, right? Takes the difference between fair value and carrying amount, that's 300,000. And then credit DTL, 30% of 300,000, credit RSC. That's for equipment. Then what about trademark? Debit trademark, 130,000, right? Credit DTL, 30% of that, credit RSC, 70% of 130,000. Now for contingent liability, we raise a provision account. We credit provision for legal claims, 30,000, debit DTA, right? And then 30% of 30,000, and then we debit revaluation surplus on consolidation for 21,000. Okay. Now, so you can see when you're combining all of these 3 entries, then you will have this one. So this actually is a combined entries, right? Okay. Now, Well, the benefits of using combined entries, we can easily figure out RSC, total balance. So this is the subsidiaries pre-acquisition. Now, RSC balance also subsidiaries pre-acquisition equity balance. Okay. Now, then we move on to look at our pre-acquisition entries. Now, the pre-acquisition entry is prepared every time the consolidation worksheet is used, right? So this is always required to be prepared in your worksheet. The purpose of pre-acquisition entry is to eliminate the parent's investment in subsidiary against the parent's share of the subsidiary's pre-acquisition equity. The parent's share is based on the parent's ownership interest in the subsidiary, that is 80%, right? So you can see here we already have RSC balance, that is 280, right, thousand, and net loss multiplied by 80%. So you can see the amount of RSC balance that required to be eliminated in your pre-acquisition is 224,000. Okay. Now, if you have combined RSC entries, so that is the benefits, you can easily get RSC balance, subsidiary RSC balance on the acquisition date. Okay. Now, don't forget to recognize the goodwill acquired by the parent as part of the pre-acquisition entry. Okay. And eliminate the parent's portion of subsidiary pre-acquisition capital, retained earnings, RSC. Okay. Now, up to here, nothing new, right? So we have learned that in the previous topic already. Okay. Now, then let's move on to look at NCI entry. Now, this is our step 1 NCI entry. So we allocate subsidiaries pre-acquisition, share capital, retained earnings, RSC, 20%, right, to NCI. So simply debit share capital, retained earnings, and RSC, so the calculation is based on 20%. Yeah. Now then, we credit non-controlling interest. Okay. So you can see these represent the balancing figure, right? This is always a balancing figure. You can verify this number. How to do that? 20% of FVNA, right? So 20% FVNA. So what is the FVNA again? What is the FVNA? 2.78 million, right? So FVNA is 2.78 million. Okay. Then multiply by 0.2, right? Because NCI is 20%. What you got? 556,000. Okay. So always remember to verify this number. So under partial goodwill methods, NCI on the acquisition that is equal to its proportionate share of subsidiaries FVNA. We already get FVNA. We just multiply 20%. You will get this number here. Okay. Now this is step 1 NCI. Do we need step 2? Do we need step 2? No, we don't need step 2. Step 2 is from the acquisition date to the beginning of the current year, right? The acquisition date is the same day of the beginning of the current year because it's only 1 year since the acquisition. We don't need a step 2. Skip that, and then we can directly move on to step 3. Okay. So what is our step 3? Oh, we forget depreciation, right? We are not recording all the RSC entry. We forget this one. Okay. Now, don't forget depreciation adjustment. There's one item in the record of subsidiary is all understated, right, compared to the fair value. So we prepare the revaluation entries for that item, and also in addition to that, we should consider subsequent depreciation adjustment. Now remember that the carrying amount is 300,000 lower than fair value. So the total adjustment of depreciation over 10 years is 300,000, each year 30,000. So we debit depreciation expense, credit accumulated depreciation, and then show your tax effect of your adjustment. So you can see DTL balance now is reversed, right? So 30% of 30,000, DTL reversed by 9,000, and the income tax expense decreased because your depreciation expense increased, resulting in decrease of the current year group profit. Okay, and these profits contributed by subsidiary, right? And the profit decrease, income tax expense decrease. Now these adjustments, now the reason they put down the adjustment here is immediately before the step 3 NCI, is to remind you to take these into account. So you can see the after-tax profit that subsidiary contribute to the group reduced by 21,000, right? Reduced by 21,000. And subsidiary reported profit, therefore, should be adjusted for this before you allocate that. So you can see this is step 3, right? Subsidiary reported profit is 120,000. And this number need to be adjusted down by 21,000 due to the current year worksheet adjustment of the depreciation and ITE. Because these adjustments relate to the asset used by subsidiary. And including in the subsidiaries record, the amount of depreciation is understated compared to the group. And your adjustment in the worksheet therefore reduce the after-tax profit of the subsidiary by 21,000. Okay. All right. Now, so you can see this is what our step 3 entries. The adjusted profit of the subsidiary, then we allocate proportionally based on 20% to NCI, and then we debit NCI share profit, credit NCI. Finally, we go back to the dividend. Okay. Now recall subsidiary paid 50,000 dividend this year. 80% of that received and recognized by parent, and that is intragroup dividend revenue. So the amount of dividend revenue in the record of parents paid by subsidiary, now this is intragroup dividend revenue required to be eliminated. So we debit dividend revenue, then we credit dividend paid. Now the dividend revenue debit reduces the profit of the parent, nothing to do with NCI. Okay? But the remaining 20% of 50,000 dividend received by NCI party. Okay? And because subsidiary payout dividend is reduced subsidiary's equity, therefore NCI share of the subsidiary's equity balance should also decrease. So we debit NCI, credit dividend paid. Now that's all. Now this practice only includes step 1 and step 3. Okay? And our lecture example include all the 3 steps. So I would suggest you to go through your homework question as well to get some more exercise. Okay? To get some more exercise. And then try to attempt the practice quiz we provided for that topic. That's pretty much enough. And towards the end, I will give you some sample question to practice for the final exam as well. Okay? Now, any other question? Oh, we finished up early today. Okay, so any question we may have? Any question, feel free to ask. You guys don't ask a lot, not a lot. You guys don't ask questions. Okay, so well, I'm not that worried since the first quiz, so the results not too bad. But there are some students not performing well in your first technical assignments. So I'm hoping to expect to see a significant improvement in the second technical assignment. And the second technical assignment only cover intragroup transactions. Okay, so drop by to my office if you have any questions. You feel free to drop by. I'm available on Wednesday and Friday. Okay, so Wednesday and Friday. So Wednesday, Friday, so after 10, you can just pop in and ask me a question if you want to. And also for quiz-specific feedback, come to see me. Okay, so if you get some specific feedback for your first technical assignment, so just drop by my office. I can give you some feedback based on the mistake, right, you made in that assessment. All right. Okay. Now, tax question won't be exempt separately again in the final, but the tax adjustment are required, right, for all the consolidation topics. So you need to make sure you know when to record DTA, when to make adjustment of DTL, okay, in your consolidation worksheet entries as well. All right, now if you guys don't have any further question, now we can finish up. So set you free, okay? So, but if you do have any question, you can stay and ask me. All right, yeah, so see you on Friday then.